Welcome to the Opening Bell Report.
I want to start off by asking you a question.
Oh, jumping right in. I like it.
Yeah, well, have you ever looked at a once beloved tech company, a stock that just seemed completely unstoppable a few years ago?
Right, the kind everyone was talking about.
Exactly, but then you watch it stumble and it just starts bleeding cash.
Which leaves the broader market wondering, if its core growth narrative is just permanently fractured.
Right, and it's a cycle we see play out time and time again in the tech sector.
Oh, absolutely. Boom and bust.
But today, we're asking a much more compelling question. Can that fractured tech growth story actually be repaired?
It's $1 million question.
Mm-hmm.
Or, well, maybe $1 billion.
Yeah. And to answer that, we're looking at a fascinating case study because the theme of our deep dive today is essentially FSLY is BPT.
Yes.
We are breaking down the epic Q4 earnings report.
And it really is the ideal focal point for this kind of discussion.
It really is.
Because for years now, investors, industry analysts, they've all been waiting to see if FSLY could actually execute a meaningful turnaround.
Right. And today we have this comprehensive analysis report,
which breaks down their fourth quarter financial data in a really revealing way.
Our mission for this deep dive is to unpack exactly how a company transitions from bleeding cash to printing it. We want to extract the crucial financial metrics that signal a true corporate turnaround.
And what we're going to explore here, it isn't just a slight beat on quarterly expectations.
No, not at all.
It looked a lot more like a structural realignment in the company's fundamental financial health. It demonstrates how a leaner operation and a strategic pivot can completely revitalize a former, pandemic-era tech darling.
Before we get into those metrics, though, we should probably ground this conversation for you, the listener, by establishing exactly what it is that FSLY does.
Yeah, that's a good idea, because they operate entirely behind the scenes.
Right. For those who might not track the infrastructure side of the internet, FSLY operates what is known as a content delivery network.
Or a CDN.
A CDN, exactly.
Yeah.
Along with edge cloud platforms.
So essentially when you stream a movie or load a really heavy e-commerce page.
Or interact with a complex web app.
Right. FSLY's network of global servers is the plumbing. They ensure that data travels from the host server to your device with almost zero latency.
Because they physically move the data closer to you.
Exactly, to the edge of the network.
Okay, so let's get right into the headline data from the analysis report. Looking at the Q4 numbers, the top line growth is where the momentum first becomes visible.
And the numbers are strong.
They really are. Total revenue for the quarter hit $172.6 million.
Which represents a 23% year-over-year growth rate.
Right, 23%. And what stands out in the breakdown of these numbers is the consistency. This isn't just a one-off fluke.
No, the report specifically marks this as their fourth consecutive quarter of revenue acceleration.
Which is huge.
It's massive. If we connect this to the bigger picture, that consecutive acceleration is arguably the most important signal for anyone analyzing a turnaround in the enterprise software space.
Because the sales cycles are so long.
Precisely. Enterprise sales cycles are notoriously slow. I mean, it can take 6 to 9 months to negotiate and close a massive infrastructure deal.
So it's not like consumer software where someone just clicks a button and subscribes.
Exactly. So when you see 4 straight quarters of accelerating growth, it tells you that the market demand isn't just a seasonal spike.
Or a one-time accounting benefit.
Right. It indicates their sales teams have found a repeatable motion, they're executing consistently, and the momentum in the market is actively compounding.
Okay, let's unpack this. Because while a 23% top-line growth is very strong, the bottom-line profitability is where the structural shift really becomes visible.
This is where it gets really fun.
The data reveals a jaw-dropping adjusted earnings per share, or EPS.
Let's hear it.
12 cents.
12 cents.
And to put that into perspective, the consensus among Wall Street analysts was expecting just 6 cents.
They managed to exactly double the consensus estimate.
Why is doubling the EPS so critical here?
Well, beating expectations by that wide of a margin is relatively rare in the infrastructure tier of tech. Analysts build these highly complex models, right? They're trying to predict these numbers down to the exact penny.
Based on server usage, headcount, that kind of stuff.
Exactly. Peering costs, all of it.
Yeah.
So missing or beating by a cent or two is just standard operating procedure.
But doubling it.
Doubling the estimate shows a level of operating leverage that the broader market simply did not believe FSLY was capable of achieving at this stage.
It means they extracted significantly more value out of their existing infrastructure than anyone modeled.
Right. Which brings up another critical metric from the Q4 data, the swing in non-GAAP net income.
Yes, the analysis report highlights this. They reached $20.1 million in positive non-GAAP net income for the quarter.
That's a massive recovery.
Especially when you compare that to the exact same quarter the previous year. They posted a $2.4 million loss back then.
So that is an over $22 million positive swing in a single year.
In a single year. And this marks their first profitable fiscal year on a non-GAAP basis.
It really proves to the market that they can successfully scale operations without just burning through cash reserves.
But let's pause on that term non-GAAP for a second because it gets thrown around a lot in earnings discussions. How should we be interpreting that specific metric?
That's a great distinction to make. GAAP stands for Generally Accepted Accounting Principles. It's the standardized way companies have to report their official numbers.
The standardized way.
Right. Non-GAAP, however, is a customized metric. The company strips out certain irregular expenses or non-cash charges.
And in the tech sector, what's the biggest thing they strip out?
Usually stock-based compensation, the shares they give to their engineers and executives.
Because giving someone stock doesn't actually cost the company cash out of their bank account today?
Precisely. It dilutes the shareholders, but it doesn't drain the corporate checking account.
That makes sense.
So while GAAP net income gives you the fully burdened official accounting reality, non-GAAP net income is incredibly useful for understanding the actual day-to-day operational cash engine of the business.
Okay, so hitting that $20.1 million in non-GAAP net income proves their daily operations are actually healthy.
Yes, they grew revenue by 23% without actively burning through their daily cash reserves to do it.
Now here's where it gets really interesting, because looking at the top and bottom lines doesn't actually explain the mechanics of how they achieved it.
Right. What's the actual driver inside the business?
The breakdown shows that Fastly's core network delivery business, that traditional CDN data moving service we talked about,
Right.
that posted a very solid 19% growth rate.
Which is good.
It is good, but the analysis report highlights a secret weapon driving the broader turnaround.
Enterprise security.
Yes. Security revenue absolutely exploded. It grew 32% year over year to hit $35.4 million.
Wow.
So you have the core CDN business growing at 19%, while the security segment is accelerating at 32%.
What's fascinating here is the intersection of network architecture and cybersecurity strategy.
Why is the market so hungry for edge security specifically?
Well, traditionally, companies routed all their web traffic through a centralized security checkpoint, like a massive firewall in a corporate data center.
Right.
But today, applications are distributed globally. Fastly operates at the edge, meaning their servers are physically located in hundreds of cities around the world.
As close to the end user as possible.
Exactly. So by integrating security directly into those edge servers, they can block DDoS attacks, they can protect APIs, and deploy firewalls instantly.
All before the malicious traffic ever gets near the customer's core infrastructure.
It's highly efficient. If you're already the pipe carrying the data, you might as well be the filter that cleans the data along the way.
But there's also a distinct business advantage to security software, isn't there? The analysis report refers to this segment as incredibly sticky.
Oh, absolutely. Security software is perhaps the stickiest product in the entire IT budget.
Why is that?
Think about the risk profile for a chief information security officer at a major enterprise. Once they integrate a platform like Fastly to protect their mission-critical apps and APIs, the switching costs become monumental.
It's not just the financial friction of buying a different vendor's software.
No, it's the operational risk. The risks associated with tearing out your fundamental security infrastructure and replacing it are just too high.
Because if a misconfiguration happens during that transition,
The company is vulnerable to downtime, data breaches, massive reputational damage.
so consequently, once a security provider is integrated and proven to be effective, the enterprise rarely leaves.
Exactly, they stay put.
And that concept of stickiness ties directly into a vital metric highlighted in the report, the net retention rate, or NRR.
Yes, the NRR.
The Q4 numbers show Fastly's NRR jumped to 110%.
For a company heavily reliant on usage-based and subscription models, hitting 110% is a major signal.
Can you translate that metric for the listener? What does an NRR of 110% actually mean?
Net retention rate is basically the pulse of any enterprise software company. An NRR of 100% means that, on average, your existing customer base is spending the exact same amount with you this year as they did last year.
Factoring in anyone who canceled.
Right. So an NRR of 110% means that the existing cohort of customers isn't just staying on the platform, proving the stickiness we just talked about, but they are actually actively increasing their financial commitment by 10% year over year.
So it's kind of like signing up for a gym membership.
Okay, I like this.
You sign up, you refuse to cancel it, and then a year later you actually upgrade to the premium personal training package.
That is a perfect analogy, and it shows that their land and expand strategy is functioning exactly as designed.
And this is where the security pivot becomes so crucial, right?
Absolutely, because Fastly isn't just relying on their clients to passively push more web traffic through the CDN to drive up the bill. That 10% expansion is largely being driven by customers adopting new, higher-margin security modules.
On top of their traditional delivery services.
Right. It is incredibly expensive to acquire a brand new enterprise logo. The customer acquisition cost involves marketing, long sales pitches, extensive proof-of-concept trials.
But upselling a new web application firewall to a client who already trusts your CDN?
The acquisition cost on that cross-sell is practically zero, which means that additional revenue drops almost entirely to the bottom line.
Which provides the perfect bridge to discuss the historic criticisms of the company.
The bear case.
Exactly. According to the analysis report, the historic bear case against FSLY was its terrible margins and severe cash burn.
The narrative was that the infrastructure required to run a global CDN was essentially a furnace for investor capital.
Right. But this report throws that bear case completely out the window.
The margin improvement is the true miracle here. It's the linchpin of this entire turnaround narrative.
Let's walk the listener through it. The financials show FSLY achieved a record non-GAAP gross margin of 64%.
Which is a substantial leap from the 57.5% they reported in the same quarter just a year prior.
Better margins mean more of every dollar earned actually drops to the company's bottom line.
Right. But if we look at the broader cloud computing and SaaS landscape, pure software as a service companies regularly post gross margins of 75%. Sometimes even exceeding 80%.
So is 64% actually considered elite here?
It's a matter of business models. Pure SaaS companies essentially just write code and host it on someone else's cloud, like AWS. Their cost of delivering the service is incredibly low.
But FSLY is an infrastructure company.
Exactly. They have to purchase physical servers, lease space in data centers globally, and pay massive transit and peering fees to internet service providers to move all that data.
So you really can't compare their margins directly to a pure software company?
No, you can't. In the context of the CDN market, moving from 57.5% to 64% in 12 months is a massive operational victory.
The analysis report mentioned earlier that management had implemented leaner operations to achieve this. Does leaner just mean standard corporate layoffs?
Headcount optimizations often play a role, sure. But the more impactful margin drivers in this specific industry come from network engineering.
How so?
CDNs historically have to over-provision their hardware. They buy way more servers than they need on an average day just to ensure they can handle massive, unexpected spikes in internet traffic without crashing.
Okay, that makes sense.
What FSLY appears to have done is fundamentally restructure their server footprint and optimize their software-defined routing.
By writing more efficient code, they can push significantly more data through their existing silicon.
Exactly. And that drastically lowers their capital expenditures, the money they have to spend buying new servers.
And when you lower that CapEx and optimize peering agreements, your cost of revenue plummets.
And that is how you drive a gross margin up by 6.5 percentage points.
Which leads us to the holy grail, the most important metric for any turnaround tech stock.
Free cash flow.
Free cash flow. The data shows FSLY generated $8.6 million in positive free cash flow this quarter.
Which is a massive reversal from the $7.9 million they lost in Q4 the previous year.
Going from a near $8 million drain to an $8.5 million surplus, that completely rewrites the risk profile of the business.
It really does. Because printing cash from operations is the ultimate proof of a healthy, sustainable business model.
Especially in this macro environment.
Oh, absolutely. A few years ago, when interest rates were near zero, tech companies could afford to burn millions in cash every quarter because capital was practically free.
They could just issue new shares or take on cheap debt.
Right. But today, debt is incredibly expensive, and issuing new shares at depressed valuations is highly dilutive. By generating positive free cash flow, FSLY proved they are now self-sustaining.
They fund their own growth.
Exactly. They control their own destiny because they no longer rely on the capital markets for survival.
So what does this all mean as we look ahead to the future?
Well, financials also provide forward-looking guidance from FSLY's management team.
The report shows they are guiding for Q1 2026 revenue to land somewhere between $168 million and $174 million.
And for the full year, they are setting top-line guidance up to $720 million.
That guidance implies management is highly confident that Q4 was not just an anomaly.
Right. It wasn't just driven by end-of-year IT budget flushes. They are forecasting sustained, durable growth.
Leaning heavily on that 32% expansion rate in the security sector to offset any pricing pressures in the traditional CDN market.
As we synthesize everything we've covered today, it's important to remind you why this matters. Whether you're a market watcher, a tech enthusiast, or just someone interested in business strategy.
FSLY proves that a company can actually shed its pandemic-era baggage.
Yes. They leaned down operations, leveraged a booming subsector in security, and returned to fundamental cash flow health.
They identified the peripheral costs dragging down their margins, optimized their physical network infrastructure, and aggressively cross-sold into a highly sticky sector.
It is a textbook example of finding operational leverage.
But the analysis report does leave us with one lingering question.
There's always a catch.
While the stock and the fundamentals are aligning, it leaves us wondering if FSLY can maintain this 20+% growth into the rest of the year. Turnarounds of this scale are notoriously difficult to initiate, but they are equally difficult to maintain.
Especially as competitors in the edge computing space aggressively try to defend their own market share.
Very true.
And that raises an important question, which is the exact thought I want to leave you with today.
Let's hear it.
We know from the data that FSLY's security segment is accelerating at 32%, while the core CDN business is growing at a resilient but slower 19%.
Yeah.
Given those diverging growth trajectories, at what point does this highly lucrative secret weapon completely overtake the original business model?
Wow.
Are we currently witnessing the early stages of FSLY fundamentally transforming from a traditional content delivery network into a pure-play cybersecurity giant?
That is a provocative thought to mull over and definitely a strategic shift to keep an eye on as the next few quarters unfold. Thank you so much for joining us on this deep dive. We'll catch you next time.
Don't forget to like, share, and subscribe for more.